I have some very exciting news for you. The Federal Reserve will be turning the money printers back on December 12th. So I just want to say that I was wrong. Back in 2024, I predicted that the Federal Reserve would turn the money printers back on in 2026. And as we got closer to next year, I thought that they're going to start that process in early 2026, but nope, December 12th. Okay, so they're not calling it quantitative easing. They're calling it reserve management. So I guess it's technically not QE. It's a rebrand. It sounds better. It sounds nicer. But I'll tell you, it's the same crap. It's balance sheet expansion. It's money printing. It's all different ways of saying the same thing. And I just want you to know that it's not going to be a small amount. They're going to start with $40 billion this month, which is wild. So they're saying, oh, we're just going to start with $40 billion a month. And then in a few months, the money printing should be a little bit less each and every month. You know, to that I call BS, because as I explained before, it's like an addict. They're going to require a bigger and bigger dosage. So they're not fooling me. I don't know who they're trying to fool. And I'll tell you this, you know what's hilarious? Jay Powell, chair of the Federal Reserve, just said that the Federal Reserve is committed to getting inflation down to 2%, even though inflation has been rising. Okay, so, this is funny to me because inflation is going up. They just cut interest rates today, and they're going to print $40 billion a month starting December 12th. So, sure, they're very committed to 2% inflation. What a joke. Give me a break. So this is why I've been stocking up on gold and silver exposure. The Federal Reserve just ended their meeting today, and they had their press conference as well. And I want to show you what happened. So this was their official statement released at 2 p.m. Eastern time today. Blah, blah, blah. It says that they've decided to cut interest rates by 0.25% today, and they decided to turn the money printers back on. Okay, so the Fed funds interest rate has now fallen from 4.0% to 3.75%. And it says that future rate cuts will be determined by the data, as usual. And here it says the Federal Reserve will initiate purchases of shorter-term Treasury securities as needed to maintain an ample supply of reserves on an ongoing basis. So the money printers are back on. There's no given end date of when they're going to turn the money printers back off. Now, here's what they published today at the New York Fed. So I'm going to zoom in here so that you can see it. The Fed will purchase, aka print, $40 billion in Treasury bills starting on December 12th. And I just want to say that today's Federal Reserve meeting and press conference was a special one because they released their projections. And of course, they don't do this at every meeting. So I want to show you what they're projecting. So we click on that and it takes us here. Their summary of economic projections, their SEP, and let's take a look. Here's the most important parts of their projections. It's going to be this table. Back in September, they projected that the US economy, so GDP, would grow by 1.8% next year in 2026. Now, they're projecting that the US economy will grow by 2.3%. So that is a big upward revision. They're projecting that the unemployment rate will end next year at 4.4%, which is actually close to where we are today. And this didn't move much from their last projection that they made back in September. Basically, they're saying that these interest rate cuts and the money printing is going to prevent further deterioration in the labor market. So they expect that the rate of inflation in 2026 to be lower than expected compared to the forecast that they made back in September. Okay, so how is inflation supposed to go down if the economy will be much stronger than expected with interest rate cuts and money printing? I don't know, but that's what they're projecting. The Federal Reserve, in my opinion, they really didn't do a good job of explaining how this is going to materialize. Now, I want you to check this out. Look at this. The Federal Reserve expects to cut interest rates only one time by 0.25% in 2026. So they're saying one interest rate cut all of next year. Now, my reaction to that is, yeah, right. Because you have to remember that Jay Powell, he's going to be out of there in 5 months. And when President Trump puts his nominee as the new Fed chair in May of 2026, I'm telling you, my expectation is that they're not going to do just one interest rate cut for all of next year. Give me a break. Now, I want to show you the highlights of the Federal Reserve press conference that they had today. Okay, let's start with this one. Let's go back to explaining why the Federal Reserve believes that the U.S. economy, or GDP, is going to be much stronger than originally anticipated. And Powell says, you're going to see it for yourself, he just chalks it up to Americans are just going to be more productive next year. Is it going to be because of AI? And Powell says, maybe a little bit because of that, but they just leave it there. Please take a look for yourself.
If I could just follow up on the SEP, you have a whole lot of big increase in the growth numbers, but not a big decline in the unemployment numbers. And is that an AI factor in there? What is going on in terms of the dynamic of you get more growth, but you don't get a whole lot of decline in unemployment? Thank you, sir.
So the implication is obviously higher productivity. And some of that may be AI. It just also, I think, productivity has just been almost structurally higher for several years now. So if you start thinking of it as 2% per year, you can sustain higher growth without more job creation. Of course, higher productivity is also what enables incomes to rise over long periods of time. So it's basically a good thing. But that's certainly the implication.
Now, I want to show you this one. It's a very good question. The question is, why are you printing so much money? Why are we starting with $40 billion a month? And Powell blames it on taxes, April 15th. So Powell says that he wants to make sure that there's enough liquidity in the system for when people go to pay their taxes on April 15th. That's his excuse. Please take a look.
So, we announced that we're resuming reserve management purchases. That is completely separate from monetary policy. It's just we need to keep an ample supply of reserves out there. Why so big? The answer to that is, if you look ahead, you will see that April 15th is coming up, and our framework is such that we want to have ample reserves even at times when reserves are at a low level temporarily. So that's what happens on tax day. People pay a lot of money to the government, reserves drop sharply and temporarily. So this seasonal buildup that we'll see in the next few months was going to happen anyway. It was going to happen because April 15th is April 15th. There's also a secular ongoing growth of the balance sheet. We have to keep reserves, call it constant as it relates to the banking system or to the whole economy. And that alone calls for us to increase about $25 billion per month. So that's a small part. That's going on. It's also happening in the context of a temporary few-month front loading to get reserves high enough to get through the tax period in mid-April. So that's what's happening there.
Now, I want to show you this video clip, and the question is that the number one concern for Americans is inflation. It's the cost of living, high prices, just the unaffordability of daily life. If that's the case, then why are you not focused? Why are you not prioritizing bringing down inflation? And Powell responds by saying that, okay, if they cut interest rates, it's going to help the labor markets, and if it helps the labor markets, then incomes are going to rise faster than inflation. So if there's good wage growth, then people are going to start feeling better about the situation. Please take a look.
You just mentioned that the public is expecting you to get back to 2%, and Americans overwhelmingly are citing high prices, inflation, as their number one concern. Can you explain to them why you're prioritizing the labor market, which seems relatively stable to most people, instead of their number one concern, inflation?
So we, as you know, we have a network of contacts in the U.S. economy, which is really unmatched if you go through the 12 reserve banks. So we hear loud and clear how people are experiencing really costs. It's really high costs. And a lot of that is not the current rate of inflation. A lot of that is just embedded higher cost due to higher inflation in 2022 and 23. So that's what's going on. And so the best thing we can do is restore inflation to its 2% goal, and our policy is intended to do that, but also have a strong economy where real wages are going up, where people are getting jobs and earning money, and we're going to need to have some years where real compensation is higher, it's positive, significantly positive, so nominal wages are higher than inflation, for people to start feeling good about the affordability issue. And, so we're working hard on that. We're trying to keep inflation under control, but also support the labor market and strong wages so that people are earning enough money and feeling economically healthy again.
Okay, so that's your Federal Reserve update. They cut interest rates today. They're going to start the money printing December 12th. They released their projections, which are pretty much meaningless because the new Fed chair is going to come in May, and it's going to be someone with a much dovish monetary policy stance. And I guess that sums it up. Thanks so much. Please subscribe. Thank you for the support. I wish you a very nice day. Take care.